So I'm a tax partner at BDO and head of our share plans and incentives practice. I'm absolutely delighted to be joined by our incredible panel of speakers across all of our national offices. So we've got David Ellis, who heads up our strategic reward practice in London. We've got Laura Burton, who is a tax director in our expatriate team in Leeds. So if we move the slide on so we can see all the pictures while we're doing that, that'd be great. And one more. We have Andrea Burberry, who is a share plans and incentives director in London, and Karen Foster, who is a tax director in our employment tax team in Ipswich. So we are genuinely coming at you from all over the UK. So this is the fourth of four workplace evolution webinars. And if you're only tuning into this one for the first one, just to let you know, in February last year, we did one around strategic insights into current employee expectations and how employers are responding to those. In May, we did a webinar around locations, discussing where your workers are working from and tackling some of the big questions around global mobility and remote working. In November, we did a webinar around employee cost efficiency and maximizing value for your costs and thinking about employment spend and compliance. And then today is all around the future, looking at tax efficient share incentives on the back of increases in capital gains tax back in October last year, how you can sell your business in a tax efficient manner and the new way of sort of doing that, pay reporting and transparency, and how companies are delivering on employees' desire for greater flexibility in the workplace. Just a quick reminder, if you do have any questions as we go through the session, can you please pop them into the Q&A section and not in the chat function? And we will definitely try and answer as many questions as we can, either as we go through or at the end. We've already got some questions that have been posted, and we will look to address those as we go. Right. If we could turn to the next slide. So what's the future for share-based incentives? Well, I thought it's actually just worth looking at what the position was and the changes that have happened. So in relation to rates of capital gains tax, we had a flat rate for higher and additional rate taxpayers of 20%. As everybody knows, that increased by 4% and it's now 24%. So quite a substantial change there, a 20% increase in the rate. We had business asset disposal relief at a 10% rate, and that was increased by 40% to 14% and will increase by another 4% going forwards, taking it to 18% from the 6th of April next year. We've got additional rates of income tax. So they've remained consistent at 45%, with employees' national insurance remaining at 2%. But the employer's NI rate has increased by 1.2%, taking that to 15%. So if we now look at the delta between the rates of capital gains tax and income tax and national insurance at the highest rates, we've got a delta now of 23%, being the 47% minus the 24% of CGT, meaning that CGT rates are effectively half those of the additional rates income tax and national insurance. And for those of the shareholders that qualify for business asset disposal relief, the delta is 33%, being 47% minus 14%, but this delta will drop down to 29% from next year when the rate of business asset disposal relief increases to 18%. So what does all this mean? Well, I guess in Q3 of 24, there was a feeling by many advisors and many companies that the rates of capital gains tax were likely to be aligned with income tax rates, meaning that the growth in the value of the shares would effectively be taxed in the same way as cash. However, obviously that didn't materialize, and the rate that was introduced was much lower. It was only a 4% increase. And we don't know what the future holds for rates of income tax or capital gains tax or any other rates for that matter. But the reality is that they are more likely to go up than they are to go down. But there was some interesting questions that we had, which was what would have been the outcome for share-based incentives had the rates of capital gains tax been aligned with income tax rates? Would companies still operate share-based incentives? Because it's something that obviously is kind of relevant for going forwards as to how they would be operating in the long term. And so there was a lot of discussion around that and thinking about, well, the natural comparator there is effectively listed companies. They still operate share-based incentives, sometimes for different reasons, but where there is no tax efficiency. And that's also the case in the US, where in the US, obviously, they've got a very established use of share incentives, and as often they are taxed as income. My experience is that the use and the decision by companies to use shares to incentivize management is much more nuanced, and you would need to consider things like the accounting implications of the incentives. Is there a cash flow or shareholder dilution a key consideration? What's the corporation tax position in relation to the operation of the incentives? Sometimes we'll see companies operating exit bonuses, and the expectation is that there would be a corporation tax deduction, but often that isn't the case, that a deduction is not available for exit bonuses that are paid. Also, which obviously contrasts with a statutory deduction that may be available for a share-based incentive. Also thinking about administration, how are the plans administered and the involvement of that, and also shareholder expectations. For example, once a cash-based incentive has been paid out, employees aren't subject to tail risk like they would be if they were a shareholder in the business going forwards. So that's quite a difference. And also the retention effect of a cash versus shares. That once the cash has been paid, it has no further retentive element. Whereas if you're a shareholder in the business, you're still holding the shares and you'll be subject to good and bad leaver provisions. So they are still quite effective at retaining you. And also thinking about the feeling of ownership. Is a cash-based incentive have the same feeling of ownership as a share-based incentive, even if it's, say, a phantom arrangement? And I guess the part of the reason is for companies operating share-based incentives is to think about employees and getting them to start acting and thinking like owners of the business, as opposed to just receiving an incentive. So I had a quick couple of polls actually that I just wanted to run by you. So if we move to the next slide, and it's really is how important is tax efficiency when you're implementing a share-based incentive? Bear in mind some of the things we just talked about in your overall experiences. So if you could just answer that, and then we've got a follow-on question that goes from that. Okay, a few more seconds, and then we will see what everybody thinks. I've got most of the answers in there, and we can just go with it. Okay. Wow. So owned for 4% of the people. So pretty much 96 people, it's either vital or useful. Okay. So I mean, I guess before we go on to the next poll, So what we do see is that lots of companies do operate share-based incentives that are still subject to tax. And this is often the case where you have US companies operating incentives, and there is no tax efficiency in the US, and they operate it in the same way throughout the world. And also cash-based incentives. And just to put it out there, it is possible to restructure some of the incentives if they are being subject to remuneration or income tax on the vesting of those arrangements, to get those arrangements into capital gains tax at a much lower rate of 24%. So do let us know if you'd like to discuss this. So if we go on to the next poll, and I guess this really goes off the back of the last question, is we've got 96 people, 96% of the people saying actually it's really important. So I guess what is the tipping point when the absence of a tax advantage would make your company move from a share-based incentive to cash? Are we already there? Is it where we've got at least a 15% delta to make it worthwhile? 5%, or you don't think there is a tipping point? I guess actually from your answer that there's only 4% of people who are going to think there's not a tipping point, but I won't prejudge the answer there. Okay, we can give a few more seconds around that because that's a slightly longer question to think through. Okay, a few more seconds. Okay, what's the results? Okay. So interesting, actually, tax is not a driver for the approach for 26%, which just conflicts slightly with actually with the previous answer a little bit. So, but for actually the majority of people there, it is around the 5 to 15%, which is very, very interesting. Okay, so we've got a little bit of time. We've got a delta there actually at the moment, still works for a lot of people, but actually we'll wait and see what happens with the next budget, and hopefully that we don't sort of move too closer to that 5 to 15%. Okay, so let's change tack slightly and move on to the next slide. I just wanted to briefly discuss the change in the way many shareholders are now looking to sell their companies. And again, it's kind of looking at the future. There are ways in which obviously people have normally approached selling their business through private equity or through trade deals. But actually, since 2014, there has been a new way that companies can be sold, and it is through employee ownership trusts. And part of the reason that people have been moving towards this is that I guess the combined impact of challenging M&A market, what has historically been over the last 5 or 6 years, high rates of interest rates and low economic growth. And there's the increase since October in the rate of capital gains tax from 20 to 24% has resulted in quite a substantial spike in the number of shareholders looking to sell their companies to employee ownership trusts. So an employee ownership trust is a trust enacted by the government to encourage more companies to become employee owned. And it allows UK resident shareholders who, subject to satisfying certain conditions, to be able to sell shares in their company for a full commercial market value and claim a complete UK capital gains tax exemption. And effectively, looking at the structure here on the chart, it works where the selling shareholders are able to sell their shares to the trustee of the EOT for full market value. And the trustee agrees to pay for the shares as and when it receives the cash from the company. So the company continues to trade, it makes profit, pays corporation tax on its profits in the normal course, and then the company transfers some of the net profit to the trustee. And when the trustee receives it, it pays it out to the former shareholders to allow it to pay down the purchase price in tranches. It's therefore a self-financing transaction which allows shareholders to be paid down over a number of years. And this is something the government has been looking to encourage, which is why they introduced a full capital gains tax exemption, saving on current rates 24% CGT. I mean, the total number of employees, employee-owned businesses at the end of 24 had increased to 2,200 companies, which is a 120% increase on 2023 of companies that sold across. And we had 800 new employee-owned businesses moving across in 2024, which means it is now the fastest growing exit mechanism for small and medium-sized businesses, with on average more than 2 companies becoming employee-owned every single day. We have seen this huge spike in the number of companies we're helping with to sell their businesses, with many saying actually it's a sort of a game changer for their ability to attract and retain talent. So if that's something you'd like to discuss with us, then obviously we'd be delighted to do that. But it is something that kind of going forwards that we are seeing a real trajectory around that, around more companies now moving across this, as opposed to going down a standard trade deal or private equity, because the sort of the time associated with doing it and the costs are just much more advantageous. So one final poll on there. So if we could do that, which is for those of you that know about employee ownership trusts, do you think it would help you lock in, incentivize, and reward your employees? Because that's one of the key drivers that the government was looking to introduce when it introduced the legislation. Okay, a couple more seconds, and then we will move on to pay governance. What do we think? Yes. Oh, 51% think yes. Okay. Well, that's really good to hear, actually, to be honest, because that's definitely something was a key driver when the legislation was introduced and when it was reviewed on the 10-year look back in October. Okay, so just turning tack, if we go to the next slide, we're going to go to pay governance. So, Karen, why should businesses be concerned about their pay governance?
That's a good question, Matt. I think there are a lot more social expectations placed on businesses now. So it's not just about complying with regulations to keep revenue and customers happy, but reputational risk is a much more important factor than it was, say, sort of 10 or 15 years ago, particularly with the publishing of sort of naming and shaming of national minimum wage defaulters. We also see it being a factor when businesses are perhaps pitching for contracts. They're asked about their ethical practices in their supply chain, their equal pay opportunities. And certainly when we're looking at businesses preparing for a sale, employment taxes, it seems to have an increasing importance in that sort of due diligence work, particularly around off-payroll labour, but also around the accuracy of their compliance with the statutory reporting. And we've seen these as sort of 5 key areas here to help businesses actively demonstrate that they are paying employees sort of fairly and appropriately for their contribution. And if I look sort of briefly at each of them in turn, auto-enrolment, well, that's been with us for quite a few years now, but as remuneration policies change and employers are required to sort of recertify that they're running a sort of compliant auto-enrolment pension scheme sort of every few years, it's important to sort of sense check that you do have the appropriate procedures and reporting in place. Sort of gender and social pay reporting, Andrea will look at in a bit more detail shortly. Holiday pay, again, a number of changes to how holiday pay is calculated, and it's important for employers to keep on top of that to ensure that that they don't have an underpayment sort of rolling up there because they've not reacted to the changes. national minimum wage, we've had increases in rates, and I think there's also a increasing understanding that it's important to consider sort of deductions from pay and how those are treated for NMW. So you can't just be happy that because you're paying sort of just over the limits that's adequate. It's important to consider as well how working hours are measured, because there could be a shortfall because you're not capturing all the working hours correctly. So there are challenges there as well. RTI reporting is really about capturing everything as far as pay is concerned, and also with the forthcoming introduction of payrolling for benefits, that will put a renewed importance on the RTI reporting element of it. But I think sort of ultimately what it comes down to is it helps to manage and mitigate sort of the risks for employers, and also to manage their employment costs, because really typically it's cheaper to get things right the first time.
Okay, that all makes perfect sense. So what measures should businesses be thinking of to help them prepare for forthcoming changes?
Yeah, well, as far as the changes are concerned, I think perhaps the one which we're having the most conversations regarding at the moment is the mandatory reporting of benefits in kind through the payroll. So hopefully most people know that this was due to come in next year from April 26, but the government announced recently that it's being postponed a year. Now, I can't say I was awfully surprised that it was put back a year, as that's not unusual when there are big changes being made, and it does give businesses a little bit longer to prepare for this. I think a quick glance, it might seem that this is a simplification, but it's important to consider what your business needs to do as far as processes and the information flow to payroll, because what we're changing is a situation where benefits in kind are reported on P11Ds at the end of the year, when you've had time to collate that information during the year and gather it all together after tax year end to put it on a form, to bringing that forward to the start of the tax year. And also having to monitor it as the year goes on, month by month, to make sure the information is flowing correctly through to payroll. And there will be one-off benefits. So it's not just simply sort of medical insurance divided by 12. There are one-off benefits, perhaps Christmas bonuses, that need to be captured and dealt with via the payroll. Aside from those sort of administration impacts, there's also a cost effect here as well, because currently with P11D reporting and voluntary payrolling of benefits, the national insurance is reported after the tax year end and paid in July. But the plan is that from April 27, when mandatory payrolling comes in, the national insurance will be paid via the payroll alongside the tax on the benefits. So essentially a business will see 18 months of national insurance paid in that first 6-month period, because they're being paid the first 6 months of the new payroll as they go along, and they will be paying the 12 months from the previous tax year. So from a cash flow point of view and sort of budgeting for that, it's important for businesses to understand the sort of roll-up impact as far as the national insurance is concerned. And there were other changes coming in as well, changes to the rules for identifying when a double cab pickup is a car or a van, and certainly the changes to national insurance and the increases there are something which have been very high profile.
Okay. Finally, what strategies are we seeing used to help mitigate the impact of the increase in employers' national insurance?
Yeah, so I think the impact for businesses will vary sort of dramatically depending on what sector they're in, and how much pressure there already is on pay rates, for instance, and how big a cost the cost of employees is a factor. But what we're seeing in terms of the what's sort of coming across our desk in response to this is perhaps businesses having a renewed sort of focus on looking at their flexible benefits package, and then particularly with regard to salary sacrifice. So salary sacrifice for pensions has been around for many years, and there were businesses which have looked at it and have decided for one reason or another that it's not for them, seem to now be revisiting that because it does offer potential savings in national insurance for both the employer and the employee, and this increase in national insurance seems to have been the tipping point, which is encouraging businesses to go back and revisit that and look at implementing a scheme.
Okay. And just to note, actually, for those that are operating share-based incentives, is that we are able to transfer the employer's national insurance liability across to the employees in relation to the share-based awards and options. Historically, a lot of companies haven't done that. But actually, it's definitely something we're seeing some companies now revisiting those decisions. Either just transferring it to the employees or actually entering into a legal agreement to transfer the liability across so they don't need to account for the employer's NI, because actually it's suddenly become quite a big number. So even that small increase is almost seen as the tipping point.
Yeah.
Okay. Thank you ever so much, Karen. Laura, so if we move to the next slide. So Laura, remote working has unsurprisingly featured across our webinar series over the last couple of them, which we mentioned at the outset. Is this a global mobility trend that is continuing?
Yeah, thanks, Matt, and good morning, everybody. As you say, naturally, we have talked about remote working a lot throughout the webinar series, and I'd say it definitely continues to be a key trend in the world of global mobility. We've spoken a lot in recent times about the compliance obligations and the employer risks associated with remote work. And I think it's fair to say that there's been great strides made by many employers now to track where their employees are working and to have a policy in place to manage the compliance that surrounds remote work. And we've seen the vast majority of our clients do now have an effective policy in place. And in the main, employees do understand that there's a requirement to seek approval before opening their laptops and working abroad. However, no matter how robust the policy, we expect that there will still be employees who fall through the cracks.
Okay, so when you have employees moving between jurisdictions, I mean, how do the tax authorities know where they are and track this, and how are the tax authorities responding to cross-border tax issues?
Yeah, so another great question, Matt, and I think that that's definitely a theme that comes up when we are talking to businesses about that. And I think definitely the direction of travel from a global point of view is the digitization of tax systems. And I think that this is ultimately how tax authorities are going to respond to this issue through automation of data collection and ultimately sharing of this information between jurisdictions. From a UK perspective, making tax digital is progressing, and we'll see the first wave of this from an income tax perspective in April 2026. And ultimately, the aim is to pre-populate data for the tax return wherever possible, with the ultimate aim being that the taxpayer themselves is simply reviewing the information that's within the tax return rather than being required to supply that information to HMRC. And as Karen noted, we're seeing the payroll of benefits, which is again part of the digitisation of the self-assessment tax return. From a global basis, some countries are much further ahead on this journey than others, which can be a symptom of the sophistication of their tax system. So we know that Estonia is very much leading the way in terms of digitisation. So I think in terms of future trends and where we're seeing governments respond to remote working and global mobile employees more generally is a policy around pre-population of data and a commitment to share information between governments. So as I put up on this slide, there's various regulations already in place that require businesses to share information between jurisdictions. And I think the ultimate vision from a global perspective is that if you have an employee who passes through security at the airport, the local authority knows from that point that they've got someone within their jurisdiction, and ultimately will be able to take information to be able to calculate the tax of that individual, provide the individual with a tax bill for their time spent in country. This information is then shared back with their home country jurisdiction, so that from a foreign tax credit perspective, that information can then be shared. So ultimately, I think the future trend will be that this is just something that happens automatically as we continue to digitise the global tax system. Next question I often get asked is, well, how close to that are we? And I think it's fair to say that that is the utopia at the moment. But there's definitely a commitment from all jurisdictions to digitise the operation of tax and share information. So I think it's coming. I don't know whether it will be in my working lifetime, but I think definitely the trend is around capturing and sharing of information.
Interesting. Sounds like there's a lot happening and a lot still to happen. So how's BDO managing this, and what are the trends that we're seeing as a professional services firm?
Yeah, I think it's always really, really interesting to look at it from a BDO perspective, Matt, and to share our experiences, because I know that this can be helpful. And yeah, our own remote working policy has definitely been very well received by our UK population, and we've had over 1,600 international remote work requests now successfully completed, and run at around 130 requests that are in progress at any one time. We've had a significant number of those that have been declined for various reasons, so including an employee not having the right to work in the country in which they're wanting to remote work from, or there may be safety and security reasons, and typically, you know, employer and tax costs are something that we look at further down the line. Interestingly, from a BDO perspective, we have a wonderfully culturally diverse population. So many of our requests for remote work are colleagues who aren't British nationals and want to spend time at home. And interestingly, what we have started to see is that the timing of those requests are seasonal and linked to national holidays in those countries, which makes a lot of sense. But what that can mean is, from a corporate tax compliance perspective, we have a requirement to manage this differently at that point, because the risk of triggering a corporate presence is going to be higher the more individuals you have in country at any one time. I think the final thing that I did want to just say and share with you in terms of our own experience from BDO is that employee communications are really, really important. And if you are going to implement a remote working policy and you spend that time getting the policy in place, it is really crucial that communications with employees are very clear, comprehensive and readily available, so that employees understand whether the request is likely to be approved or declined at the point of making it. So we make sure that we have dedicated information available, and the individuals have a kind of step-by-step guide to how remote working works.
Laura, thank you ever so much. That was super interesting, very insightful. Thank you. Next slide, it's Andrea who's going to talk about global pay and reporting. So, Andrea, we've seen gender pay gap reporting in places for, well, for a good few years now. It's been in place. So are we expecting any movement in terms of expanding its reach to, I guess, like, you know, smaller companies or additional areas such as ethnicity?
Thanks, Matthew, and good morning, everyone. I mean, the short answer is both yes and no, in fact. So the gender pay gap reporting has been around since 2017 when it was introduced. There's definitely been some conversations since its introduction about expanding it to a smaller population of employees and therefore reaching smaller companies, or to go slightly further than it currently does by making a narrative, which is currently voluntary, by making that mandatory. And there's a number of European countries that have a requirement for action plans, and also companies with smaller numbers of employees being caught in places like France and Italy and some of the Scandinavian countries who have a much smaller threshold. However, in light of what was announced in the King's Speech last year regarding extending this to ethnicity and disability reporting, I think it's probably unlikely that we'll see any change to the gender pay gap reporting in the short term. So the King's Speech obviously announced that there was going to be an introduction of mandatory ethnicity and disability reporting by way of introduction of the bill. We don't have any draft legislation as yet, but there was a consultation published towards the end of March this year, which does set out some of the detail that we could perhaps expect to see as part of that new legislation. So the expectation is that ethnicity and disability reporting will align to the current gender pay gap regulations and mirror these, but with the proviso and the caveat that actually there are a couple of distinct areas that particularly need to be considered around both data collection and analysis for the ethnicity and the disability pay gap reporting. So when the previous government were talking about the potential to introduce ethnicity reporting, there was a lot of conversation around how difficult in practice this might actually be for particularly smaller companies where you've got a very small ethnic population within the overall workforce, not just in terms of sort of data collection, but actually around privacy issues and identification of those individuals. So if you have a very small number in a particular ethnic category, it will be so much easier to identify those particular individuals within the workforce, and that was a great concern and actually quite a big driver of why the previous government decided not to pursue ethnicity reporting. However, the proposals that are out in the consultation at the moment do go some way to trying to address those particular issues. So they're talking about there being a minimum number of employees within a particular ethnic category. So if you have less than 10, you wouldn't actually report on that category alone. You would combine it with other categories so that you have a larger number of employees within a particular category, and therefore that hopefully will deal with the privacy and the identification issues. And then for those businesses that actually have very, very small numbers of ethnic employees within their workforce, the expectation is that they would simply perform a binary calculation. So you would just look at a comparison of sort of white employees versus ethnic employees to address that sort of privacy issue. And in fact, the consultation does suggest that that should happen as a minimum level of reporting. But for companies that do have the ability to look at it in more detail, the expectation is that categories would be used. And so hence the consultation is seeking views on that at the moment. The other aspect around the ethnicity and disability reporting is it does go slightly further than the current gender pay gap reporting. So the expectation is that it will be a requirement for employers to disclose the overall breakdown of the workforce by reference to ethnicity and disability, and also the percentage of employees that don't disclose. So obviously at the moment, all businesses have information on gender as part of their normal sort of holding of information on employees, but it won't be expected to be mandatory to require employees to disclose whether they have a disability or not, or which ethnic group, if any, they identify with. So I think one of the key things is going to be around that communication process with employees to ensure that businesses get that kind of data. And if there is not a great response rate to that data, then I think the ability to show in a narrative or show in the figures that actually only 50% of the workforce have responded to declare which particular category they fall into should give some additional context to a company's figures. And similarly, if you have a company which is recruiting quite diversely at entry level, that might also similarly skew ethnicity figures, because they will show that there is a bigger gap, but it will be necessary to see that actually that gap is because there's a more diverse drive in terms of recruitment. one of the additional complexities with disability reporting is going to be around individuals identifying potentially with more than one disability category and how they would sort of place themselves within that. So the expectation of the mandatory reporting is going to be that disability would just simply be done on a binary level. So you would just compare fully abled employees with disabled employees and give a flat figure, and there wouldn't be any drive to look at further detail around that, which could be quite difficult in practice.
Okay, so you've touched on what existing and future obligations might look like. So practically, Andrea, what can businesses do now to prepare for increased reporting and governance regarding extended pay gap reporting further down the line?
Yeah, that's a great question, Matthew. So I think the bottom line is businesses will need to start thinking about this early. As I mentioned, it won't be the kind of data that they would typically hold within the workforce. So I think they're going to think about what data they already hold and how best to go about collecting that data. And I think because the declaration rates of employees are going to be so important to how meaningful the end data a company collects is, that communication process with employees is actually going to become very important, because that's going to definitely inform how good the response from employees are. So I think if companies can make a great effort in terms of communicating with their employees why they need the data, and also give them reassurance around the purpose of that data and around the safeguards over individual identification within the exercise, I think that's probably going to lead to a much better response rate from employees. And obviously, the higher the rate of declaration from the employees around whether they fall into an ethnic category or a disability category, the better the data is going to be, the more meaningful the analysis and more representative, obviously, it will be of the business as a whole if you have a much higher response rate. And I also think companies probably are going to want to do a dry run of the ethnicity and disability reporting. And we found this with the gender pay gap reporting, that actually the first year that you've got to report, having a set of figures that you can benchmark to and compare to that were not mandatory reportable, but you can look back to, is actually quite helpful in terms of being able to tell that story of how the company is progressing and so on. So I think it's going to be quite useful to do that sort of dry run attempt for companies going forward. And we don't know a date in terms of when it's going to come in. So I think the expectation is that there will probably be legislation next year, and then most likely we're looking at a reporting date probably in 2027, which, aligned to the gender pay gap reporting, will look back at the prior 12 months. So there'll still be a little bit of time for businesses to kind of get their ducks in a row, but it's definitely something that they don't want to be sitting on for too long.
Okay, and finally, and very briefly, I guess there's been some divergence between the US and Europe now in terms of DE&I. How do you see that playing out?
I think that's very interesting, because with the introduction of the EU Pay Transparency Directive, we've now got sort of two different regimes on different sides of the Atlantic. And obviously recently we've seen the US administration giving a very strong message about rolling back on DE&I policies and so on. The US doesn't have any gender pay gap reporting obligations in place, and so it's unlikely that we'll see anything in that area and around ethnicity in the future, although there are requirements for pay transparency in a number of US states that are going to come into place in 2025. And then going the other way, we have the EU, which many countries already have much more stringent requirements than the UK in terms of its gender pay gap reporting. But the directive also covers other areas as well as gender pay gap reporting, so around pay policy and information rights of individuals and so on. So, and I think obviously in the UK, we're sort of in between the two because we're no longer part of Brexit. But I think we may well see the Pay Transparency Directive sort of coming into the UK through the back door, as it were, because those UK headquarters companies that have a global footprint are going to face a challenge of having to address different reporting obligations in the different countries that they operate in. And actually, that could be quite challenging for businesses. And I think they may want to take a much more one business approach and look at that on a sort of a global basis by reference to what is the most stringent requirement we have to meet in all of the countries we operate in, and operate on that basis for everybody, because you are then doing one set of analysis in exactly the same manner across the board. So I think it will be interesting when we see this getting transposed into local legislation next year, as is required by the directive, and then once the reporting obligations start coming into play, which is on a phased basis from 2027. Thank
you, Andrea. Okay, David. So if we go on to the next slide. Okay. So David, organizations seem to exist in an almost perpetual loop of continuous improvement when it comes to their people propositions. But as budgets are squeezed and the level of noise around what good look like increases, what should businesses be focusing on to make them able to attract, keep, and engage their people in 2025?
In 2025. Right. Let me have a quick go at this, because I obviously have had a chance to think about it in advance. It's not a question cold, I suppose. We should probably give that little trade secret away. Look, in the scheme of things, we have got some headwinds from an organisational perspective that are making decisions around reward and broader people proposition quite difficult. So we have national insurance having gone up. We have clearly some headwinds around trading, depending upon what sector you sit in, either where that be uncertainty or actually failing to hit the budgets that you set at the outset of the year. And conceptually, organisations are responding to those in a variety of different ways. So I'm looking at this resolutely from the positive perspective, because obviously there are lots of things an organisation can do to curtail activity or to reduce headcount or to manage performance. But what this is really focusing on is, if your pay review budget for this year has been or will be squeezed, what is it that people are looking at to try to get to a place where they remain ahead of the curve? And the word that is most valuable from an organisational perspective as we speak is this one: flexibility. Conceptually, the organisations that have got a fast start or indeed a head start on some of those headwinds are those which have managed to make a virtue or a positive out of delivering the flexibility to employees that they genuinely want or desire, or in some cases require, in fairness. And what we've put up here is a tiny bit of data from the first of these webinars that we ran, where 80% of the population who dialed into that webinar believed the biggest change in employee expectation was a desire for greater flexibility. And it hits all angles. So that might be flexibility around where people work, and Laura touched on where in the world. It might be where in the context of your office or your home, or working remotely more generally. Definitely flexibility around how much someone works. I am way too old to take advantage of this. I've worked out there does seem to be a clear generational skew to this. But the concept of enabling people to run or deliver side hustles alongside their work is actually something now which, if you can see your way doing, people will value it enormously. The side hustles are exactly what you might think. At the very benign end, people are trading stuff on eBay or Vinted or whatever it might be. There are some somewhat odder ones out there too, which probably we won't go into today, but it's ultimately looking at whether you mind that from an employer perspective. Flexibility as to how much people work, literally in terms of the hours that they are doing. You can see there's a little bit of data here, and we'll ping these around after so you can look at them in a bit more detail, but how obviously in the pandemic, the average hours worked dipped hugely, but actually it's it is going down on the pre-pandemic trend. So there is something really interesting there around how much people are working. The reason I'm talking about flexibility in the context of the question posed is that offering flexibility, however which way you're comfortable to do so, is free. So if you offer it in an environment where you have guardrails, but also some trust, you will find yourself with a people proposition which is super value to those individuals who value flexibility, which substantively it would appear is almost everyone. And that isn't generationally split. We just have a different definition of what sort of flexibility we value. So I genuinely believe that where you've got a pay review that sat at 4-point-something% last year and might be sitting at 3-point-something% this year, for example, to combine your pay story with some clarification or perhaps some new bandwidth around flexibility in whichever way you can is unequivocally positive, as compared, of course, to the organisations which are curtailing flexibility, which we read about in the papers every week, which is unequivocally negative. They might be doing it for the best of reasons, and they might be doing it to drive different things in the workplace, but we shouldn't pretend that they are popular decisions. They are not. So if we are enhancing proposition, flexibility is where it's at. It's both free and it's enormously valued. That's my thought.
There you go. Thank you. So David, I've talked quite a bit around incentives at the outset, and actually whether it's cash or share-based incentives. What are we seeing around sort of performance conditions being used as part of any incentivization process? What's been applied to those?
So it's always useful to touch, and these conversations are interconnected, even though they might seem quite disparate. The headwinds that I kind of led with at the outset, be that volatility, be it increased cost base, be it challenging trading conditions, they not only have an impact on the extent to which employees have a different reward offer, they actually, from an employer perspective, impact what you might be paying for. So if we think about it, what the imposition of tariffs have done in certain sectors overnight is create huge volatility in results that organizations might be delivering. They might be selling less, they might be pausing, they might be stockpiling, ultimately inventory, and you can see that one of the first casualties of this volatility is the extent to which people are able to predict outcomes in order to put targets around them. And so whether that's an annual bonus arrangement or whether it's a long-term plan, conceptually, point one, therefore, is that difficulty in target setting or volatility in outcomes creates a schism in terms of what you're measuring. In the context of what people are measuring, most of the metrics that we see out there being used today are broadly consistent with what they always were. Profit, earnings, revenue. We've clearly got, from a long-term perspective, aspects around return on capital or return to shareholders. Substantively, the two things is just worth noting which are growing in prevalence and continue to grow in prevalence are firstly measuring strategic objectives which are not entirely financial in nature. So that would be point one, because that responds quite well to volatility because results are not directly impacting those outcomes. And secondly, the continuing trend to use environmental, social, or governance objectives in your short-term and your long-term incentives, which is the subject of some, I think it's fair to say, wonderment as to whether putting these things into variable pay plans are producing better outcomes from an environmental, social, or governance perspective, as compared to just enabling people to be paid more, which in fairness, that's probably where the data is taking us. But we shouldn't lose sight of the fact that volatility in outcome and volatility in trading performance tends to push organizations to put a greater portion of pay dependent upon hitting strategic non-financial measures, including ESG ones, and that ultimately is where it will take us. This is always cyclical, so it will go back the other way in a relatively short order. But as it stands today, we will find more organisations paying individuals for delivering performance which is not entirely linked to the financial results delivered in the period which is being measured.
Thank you, David. So we've got 5 minutes left, and I'll just try and rattle through a couple of the questions that have come in. So the first question, which I'll have a stab at, but David, you might want to chip in as well, actually, with your thoughts around this, is what percentage should you allocate to incentivize and retain senior management? And the question doesn't say whether it relates to a listed or an unlisted business. So, and the position generally is quite different if it's listed or unlisted. I guess just giving a very quick sort of 30-second answer, I guess to a certain extent it depends. Some companies approach this and they're trying to do a percentage of shares which they'll put under option based on base salary. Other companies, which we might talk about, is say, well, let's have a conversation, talk about what an exit might look like and what's the value of 1% of the company on an exit. And then you make a determination then how much you want to pay your individuals based on, do you think X percent will be sufficiently incentivizing, not incentivizing enough? Would it be a real stretch? And thinking about then what's it worth on an exit? Also thinking about how long to an exit if the company isn't listed. We've talked about performance conditions. David's just done that around. You might have a higher percentage if you've got very stretching performance conditions. Guess it depends on the seniority of the individuals. And also thinking about, dilution, whether you've got an equity pool on there and what percentage the shareholders are prepared to give away at this point, or whether it's going to be a one-off award and there's no further awards, or whether you're going to do it on an annualized basis. So there's kind of a lot in there. Dave, have I kind of missed anything that you'd be saying that I should be?
Just an observation around pay mix. So if you were to think around the largest UK listed company, a very large proportion of their package would be variable, be it short term or long term. So you can see proportionately you are overly focusing on pay for performance rather than fixed pay. Admittedly, the median pay in a FTSE 100 business for a chief exec is probably about 4 million quid. So you've a reasonable amount to play with on an annual basis there to get that pay mix right. And of course, as the organisations get smaller, the numbers change, extraordinarily quickly. So that 4 million would translate down to sub $1 million if you were looking in a FTSE small cap business. But even in a FTSE small cap business, the CEO would probably have easily half their package would be variable in nature. So conceptually, think about it not just in terms of what are you asking people to do, but also on an annualized basis, how much of their package is at risk for doing that. And at the senior level, in most organizations, the percentage of that package which is variable, i.e. linked to performance, it is actually pretty high, much higher in larger businesses than smaller ones. But even in smaller ones, you would expect to see a chunk of pay at risk on a percentage basis, much closer to 50% of the total package than perhaps people might think.
Okay, I think we've got time for one more question. So somebody's raised one: specific watch outs re awards of shares in foreign parent company as part of global LTIP scheme (brackets free shares). So specific watch outs, I guess things around withholding. Is there withholding obligations in those different jurisdictions? Are you withholding at the right tax rates? Generally, you'll get companies that will withhold at a slightly higher rate or a fixed rate on there, and then they will then sell a certain number of shares then to cover the tax liabilities. I guess thinking about, reporting, making sure that it's all properly reported and the plans are registered if there's a requirement to do so. Definitely thinking about regulatory environment, especially like in the US as well, is really important. Internationally mobile employees is a super important one, and obviously can cause lots of headaches where you've got employees moving between lots of different jurisdictions and they have tax print all over the place. So I'm conscious that we've got a few seconds left. So all I wanted to say is thank you ever so much for joining us. A copy of the slides and the recording will be sent together with a link to the previous webinars should you want to have a look. Please feel free to contact any of today's panel around any of the questions or any additional questions you may have. All of the contact details at the back of the slide. So if you've gone there, you'll have phone numbers and email addresses if you've got any questions or follow up on there. But all that's left for me to do is to say thank you ever so much for joining us, and I wish you a very pleasant day. Thank you.